Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Worthington Enterprises Inc. quarterly report. Worthington Enterprises Inc. offers a diverse range of products and services through its two primary segments, consumer products and building products. The consumer products segment provides various tools and accessories for both professional and DIY users. These include handheld torches, micro-torches, lighters, precision tools, drywall tools, propane-filled cylinders, helium-filled balloon kits, and gas grills and pizza ovens. The company sells these products under several well-known brands, including Balloon Time, Burnsomatic, Coleman, Garden Weasel, General, Halo, Hawkeye, Levelfiv, Magtorch, Pactal International, and Worthington Pro Grade. In addition to consumer products, the building products segment offers pressurized containment solutions for various industries. These include refrigerant gas cylinders, liquefied petroleum gas cylinders, well water tanks, expansion tanks, fire suppression tanks, chemical tanks, foam and adhesive tanks, and sealing suspension systems. The company's building products cater primarily to commercial, residential, and industrial markets. Overall, Worthington Enterprises, Inc. provides a wide range of products and services that cater to various industries and consumer needs. Worthington Enterprises, Inc. market capitalization of $3 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Worthington Enterprises, Inc. holds a significant advantage in their industry. Worthington Enterprises, Inc. trades at a higher price-to-earnings ratio of 168 times and a higher price-to-book ratio of 2.71 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 45% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be categorized into several key areas. Net sales, which include both increases and decreases in revenue, play a crucial role in determining revenue growth or decline. Additionally, changes in product mix and pricing, as well as market acceptance of products, also significantly impact revenue. Other factors that contribute to revenue growth or decline include commodity price fluctuations, such as those experienced with steel and aluminum costs. Changes in tariffs and trade regulations can also have a significant effect on revenue. Furthermore, acquisitions and joint ventures can drive revenue growth or decline through the integration of newly acquired businesses. Demand trends including moderating inflation, mixed housing and construction activity, elevated interest rates, and cautious consumer sentiment also impact revenue growth or decline. Finally, inventory demand cycles, such as customer destocking and restocking, can affect revenue growth or decline. Net income has experienced a significant increase over the past year, with a notable rise of 17.1% from the prior year period to the current year period. This growth is evident when comparing the net income figures for both periods, which show an increase of $18.2 million and $28,613 respectively. The profit margins have also undergone a change, with a noticeable improvement in the overall margin. The current year period has seen a 0.9% increase in profit margins compared to the prior year period, resulting in a margin of 8.3%. This uptick is attributed to an increase in net profit margin from 11.9% to 12.6% for the 3 months ended February 28. However, it's worth noting that gross profit margin has experienced a slight decline, decreasing from 29.3% in 2025 to 28.9% in 2026 for the same period. This decrease is somewhat offset by the increase in net profit margin, which suggests that the company may be experiencing some efficiency gains or cost savings that are contributing to its improved profitability. The company is indeed generating positive operating cash flow. This is evident from the financial statements for both the 3 months and 9 months ended February 28, 2026. For the 3-month period, the net cash provided by operating activities was a substantial $61,938, page 13. This indicates that the company's operations are generating sufficient cash to cover its expenses and investments during this brief timeframe. A more comprehensive picture emerges when examining the 9-month period. In this case, the net cash provided by operating activities reached an impressive $154,518, pages 13 and 43. This significant increase in operating cash flow over a longer period suggests that the company's business model is generating consistent and substantial cash inflows. Overall, these financial metrics demonstrate that the company is successfully producing positive operating cash flow, which is a crucial indicator of its financial health and stability. The company's financial health has undergone significant changes over the past year. A notable increase in debt level is evident, with total liabilities rising by $64,063 from $756,915 to $820,978. This trend continues into 2026, where the debt level as of February 28 stands at $4,792 borrowings outstanding. Furthermore, the company's interest expenses have also seen a substantial increase, jumping from $628,000 to $1,828,000, representing a staggering 191% rise. This surge in interest expenses is not limited to one quarter or period, but has been consistent across multiple timeframes. The gross interest expenses for 2026 are higher than those of 2025 by $1,213,000. While the company's total interest expenses have decreased for WAVE, they have increased for other. Additionally, both the current year quarter and period have seen a significant increase in interest expenses, amounting to $1.2 million. These changes indicate that the company is shouldering a heavier burden of debt-related costs, which may impact its overall financial performance. The company's performance can be analyzed through its various segments and regions. In terms of strong performance, the building products segment, specifically WAVE, has shown notable results on page 16. Additionally, the consumer products segment has also performed well over both 3-month and 9-month periods ending February 28, 2026, as mentioned on page 21. On the other hand, some segments have underperformed. Within the building products segment, Clark Dietrich has struggled, as indicated on page 16. Furthermore, the other category has also experienced difficulties, as noted on the same page. These areas require attention to improve overall performance and address any underlying issues. Management's primary goal for the company is to create value for shareholders. They expect demand for their products to be closely tied to broader economic conditions, including inflation, interest rates, and consumer sentiment. The company operates in a cyclical business, which means that cash flows from operating activities may fluctuate due to economic and industry conditions. To mitigate this risk, management plans to prioritize strengthening the company's liquidity and capital structure through various means, such as repurchasing outstanding debt or issuing new debt/equity. While they do not currently anticipate a need to access capital, they reserve the right to seek additional capital by issuing new debt and/or equity securities if needed. Management is also confident that judicial and administrative proceedings will not have a material adverse effect on the business. The company's strategy aligns with its long-term priorities and focuses on growing earnings through optimizing operations, developing innovative products, and pursuing strategic investments and acquisitions. Overall, management is optimistic about the company's outlook and is taking proactive steps to ensure its financial stability and growth. The company has made several strategic acquisitions and divestitures over a period of time. In terms of acquisitions, the company has purchased Ragasco for $108.6 million in June 2024, Elgin for $90.7 million in June 2025, Hydrostat's propane distribution and refurbishment assets for $9.6 million in December 2025, and LSI for $206.1 million in January 2026. These acquisitions are expected to enhance the company's capabilities and expand its market reach. On the other hand, the company has also made some divestitures, including a 49% interest in the composite business of SES joint venture for an undisclosed amount in October 2025. This move is likely aimed at streamlining operations and focusing on core businesses. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying out dividends. According to the provided information, the company paid out $27.5 million in dividends on common shares. In addition to paying dividends, the company has also taken steps to return value to its shareholders through share buybacks. Specifically, the company repurchased 450,000 common shares for a total of $25.3 million. This demonstrates the company's commitment to creating value for its shareholders and reflects positively on its financial management practices. There are concerns about inventory buildup in the company's operations. The data shows a significant increase in total inventories over the past year, with a notable rise of $28,195. This growth is largely driven by an increase in raw materials and finished products, while work-in-process inventories have actually decreased. A closer look at the quarterly data reveals that inventory levels continued to rise even in the 3 months ended February 28, 2026, increasing by $10,998. Furthermore, the amortization of inventory step-up costs has also increased significantly, from $1,477 in 2025 to $3,651 in 2026. These trends suggest that the company may be experiencing issues with inventory buildup and potentially even supply chain disruptions. The accumulation of excess inventory can lead to wasted resources, reduced cash flow, and decreased efficiency. It is essential for management to address these concerns and implement strategies to optimize inventory levels and prevent potential supply chain disruptions. That concludes the financial summary for Worthington Enterprises Inc. Feel free to comment below, and I will be happy to answer them when possible.